Hi, this is Jason Fink at Graves Light Lenhart. This quarter, our presentation will focus primarily on the state of the economy, as it provides the key underpinnings of the financial environment. When financial stresses and opportunities arise, understanding the dynamics of the economy provides the fundamentals for understanding the nature of those shocks and therefore the logical investment response to them. The story of the economy post-COVID has been written around the antagonist inflation. Inflation began to increase sharply in the first quarter of 2021, peaking in mid-2022 at about 9%. Inflation is illustrated in the upper figure here with the change in the headline CPI, the Consumer Price Index, in blue, and the change in the core CPI in orange. The CPI change just gives the price of a typical basket of goods consumed by a U.S. urban consumer. Core CPI is just the change in the same basket of goods, but not counting food or energy. This is a useful measure for the Federal Reserve as they consider policy because those prices are quite volatile and not well affected by monetary policy. The primary tool available to the Federal Reserve to combat inflation is the federal funds rate, which is the rate received by banks when they deposit excess funds overnight. When inflation rises, the Federal Reserve raises this rate so as to increase the value of the deposits. This has the effect of slowing the economy and with it inflation. We can see the federal funds rate in the lower figure. The Fed was clearly late in addressing inflation in 2021 and didn't start raising rates until early 2022. However, they were aggressive in 2022 in raising rates, and it is also clear that in so doing, they were able to bring inflation under control by whatever measure one prefers to evaluate it. Last measured in August of 2024, CPI inflation has fallen to 2.6% growth year over year, while core CPI inflation is at 3.3%. The stated goal of the Federal Reserve is to maintain an inflation rate that averages 2% growth over time. By this measure, it is arguable that the decline in inflation has not yet been sufficient to fully achieve Federal Reserve goals. Recent trends, however, have certainly been favorable. However, the increase of rates has had the expected effect. It has slowed some sectors of the economy. Over the past couple of years, many economists have repeatedly claimed that a recession was imminent. Here at Graves Light Lenhart, we're happy we have not heeded those calls. The caution in the current environment is clearly prudent. The economy has performed solidly since mid-2022, better than the long-run average of the U.S. economy. However, the unemployment rate has slowly ticked up over time. In mid-2022, the unemployment rate was about 3.5%. In September of 2024, it was 4.1%. The unemployment rate is still low, but it has been creeping up recently, and keeping unemployment low is the second half of the Federal Reserve's dual mandate. The Federal Reserve recently decided that the risks were greater on the labor market side of their mandate, and so lowered the federal funds rate, which can be seen here. This should spur the economy a bit and begin to help the labor market. It also, however, increases the risks associated with inflation, which again has not fully come back to the Federal Reserve's goals. As we mentioned, the Federal Reserve was late in dealing with inflation in 2021. What appears to be the case is that they do not want to be late in dealing with the labor market stress this time around. And so, they have taken the step to lower the federal funds rate before the fight against that inflation antagonist is completely won. The calculation of the Federal Reserve is that the momentum will bring it down the rest of the way, or at least keep it from increasing again. It remains to be seen whether that is indeed the conclusion of this chapter on inflation. In the meantime, the boost to the economy is welcome. Markets reacted well, and the lower interest rate environment should help out the labor market. However, it is worth remembering that the labor market isn't particularly weak. 4.1% unemployment is still well below the typical level over the last 20 years. Labor force participation among prime working age individuals aged 25 to 54 has been increasing steadily since COVID and is very near its all-time highs from the late 1990s. Those dropping out of the workforce appear to be older individuals, as their participation has never recovered from COVID. Labor market dynamics are complicated, and it remains to be seen what the effect of the Fed action will be, especially as the Fed is expected to continue cutting rates over the next several meetings. In support of the labor market, the U.S. economy continues to perform. With the exception of a dip in early 2022, the post-COVID economy has been quite solid, and in the second quarter of 2024, the economy grew at an annualized pace of 3%. Further, most analysts believe GDP growth has continued to be solid. For example, last updated on October 1st, the Atlanta Fed GDP Now measure estimates third quarter real GDP growth at an annualized 2.5%. Most economists would agree that a series of federal funds rate cuts have had a positive effect on the real economy, and similarly, an upward effect on inflation. But those cuts do not occur in a vacuum. The Federal Reserve is clearly worried about at least the potential for economic weakness looking forward, and are attempting to stave off that weakness. How that tension between economic growth and inflation will play out remains to be seen. The equity markets in the United States continue to be relatively expensive. The cyclically adjusted PE ratio, or CAPE, that has been shown in academic studies to be inversely related to future returns remains stubbornly high and has been increasing over the last 15 years. By comparison, when we examine the same measure over all other developed countries, we find it at a value much closer to historical norms. As can be seen in this figure, since the financial crisis of 2008 and 9, valuation in the US and other developed countries has gradually separated. While forecasting equity market returns in the short run is virtually impossible, and even in the long run is quite difficult, there are few intermediate or long-term examples of US equity markets performing well when beginning from such high valuations. As a result, our positioning tends to lean toward international markets. However, the future is always uncertain, and U.S. markets have been important drivers of wealth over the long run. For this reason, we continue to keep the lion's share of our equity investments in the United States, although we allocate to investments with more favorable valuation profiles than the benchmark indices. The wealth-generating capacity of U.S. markets has been consistent for a very long time, and that history strongly suggests that remaining invested domestically is a prudent strategy. This is particularly important during the noise and fury of an election season, when partisan passions can lead to impulsive decisions. Allowing political views to shape investment strategy has the potential to be quite hazardous to one's wealth. A second major development in U.S. markets is the increased concentration of stock valuations. Post-COVID, the relative market capitalizations of the top stocks have dwarfed those of other firms. The chart on the left compares the weights in the S&P 500 of the top 10 stocks along with the next 40 through 2023. The small table on the right provides a detailed breakdown of the weight of each of those top 10 stocks, updated on October 1st. The weight of the top 10 stocks in the S&P 500 now exceeds 35% of the valuation of the entire index. Research is mixed as to the implications of this type of concentration on returns. However, such concentration diminishes the diversification level of value-weighted portfolios, which has the potential to increase risk during downturns. We are especially wary of this risk given the high valuations of the U.S. market and the leading firms in particular. When interest rates hit their peak, they rarely stay there for an extended period. Even as we have observed some recent reduction in interest rate levels, we still see ample opportunities for our clients. The blue diamonds are current yields as of the end of the most recent quarter, and the gray bars are the range of the yields for the given instrument over the last 10 years. The Federal Reserve's move to a less restrictive monetary stance has resulted in broadly lower interest rates for fixed income investments over the past few months. However, yield levels generally remain compelling across various fixed income markets where investors are looking for income combined with lower volatility in their portfolios. Overall, we continue to typically favor higher credit quality bonds. Additionally, investment-grade municipal bonds can provide attractive tax-equivalent yields for clients in higher marginal tax brackets. Here we see the U.S. Treasury yield curve at multiple points since August of 2020. Changes in the shape of the U.S. Treasury yield curve can be helpful in illustrating what the Federal Reserve is doing, as well as for gauging market perceptions on the condition of the U.S. economy. Typically, the yield curve takes on a positive slope as investors seek additional compensation for lending their money over a long-term horizon. However, In recent years, the U.S. Treasury yield curve has been inverted, which is when short-term yield levels are above the levels of longer-term yields. Investors tend to take notice when this occurs, as yield curve inversion often precedes recessions. As the various curves demonstrate, since peak inversion of July 2023, we have followed a bit of a meandering path to our current state, which is illustrated by the blue line. We are now in a situation where the curve is inverted over some intervals and upward sloping over others. Given the expected behavior of the Fed, it seems likely that the yield curve will gradually return to upward sloping normalcy through time. However, interest rate forecasting is notoriously difficult. Translating this into investment decisions requires the recognition that the situation implies reinvestment rate risk for very short-term debt securities. This recognition drives our recommendation to maintain an intermediate duration for fixed income securities, around 4 to 5 years, to capture more attractive yield levels over a longer time horizon. Thank you for your time and interest. We hope you found this information useful and informative. As always, please feel comfortable reaching out to us if you have any questions or wish to discuss these or any other issues. We're here to help.